All right, folks, we're going to get started. Thanks, everyone, for coming. My name's Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many years. We host events from San Jose to San Francisco multiple times a week. We have a busy calendar of events. I'd like to highlight one event that's coming up tomorrow, AI and the Future of Autonomous Vehicles. That's at CGC Innovation Center. It's just a few blocks away. That'll be a great event, so please check that out. Check out all the details on our website, ideatoipo.com. We launched on February 1st, 2010. We had no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area, and we've completed over 1,921 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none. Thank you, I think. In any case, we have many partners to help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of players in Silicon Valley. Tonight, we're grateful to Mindrome for hosting us at this beautiful venue. Is this a beautiful venue? Yes. Yes, it's a beautiful venue. Anyway, it's a great place to set up shop if you're a startup. It's a co-working space. So talk to me later. If you're interested in finding out more, I'll connect you with the manager of Mindrome. One of our other partners is here tonight. Let's hear it for Michelle and Cambria.
Hi, I'm Michelle. I'm an ICO advisor, actually, and tonight I'm representing Cambria. Cambria is an open, collaborative, open innovation platform where they're on the blockchain, and they give you a bunch of tools so that you can collaborate and innovate with a community. So we host hackathons. So if you guys are developers or interested in crypto and blockchain, please sign up at cambria.io. Thank you. Also, I have a raffle that I will do later on after the event.
Yeah, the grand prize is a T-shirt. Whoopie-doo. Though our local mission is to support entrepreneurs here in Silicon Valley, our greater mission, though, is to democratize entrepreneurship and innovation all around the world. So to that end, we have a robust YouTube channel, youtube.com/idea-to-IPO. We have tons of videos. We've documented and archived many of our events, and this rich, valuable content is available on demand, anytime, anywhere, totally free of charge. Our partner in that endeavor is Tim Jeggers of Jeggers Films. So let's hear it for Tim.
How's it going, everybody? Thank you for coming out tonight. So I'm Tim. I've been doing the video events with Rob for a long time, video for his events, I should say. I do corporate events, seminars, conferences, started filming weddings, probably not really relevant. Yeah, I'm all over the Bay Area. I do promotional content, branding material, photography, multimedia. I got started with AV, so I'm interested in all sorts of stuff. I dabble with all sorts of things. So if you have questions about video specifically, I'm definitely your guy, but anything multimedia or tech related in the content creation sector, I could probably be someone worth talking to about any of that. So I'm going to go ahead and pass it back, and thank you again for coming.
All right, so as Tim mentioned, we videotape a lot of our events for our YouTube channel. So here's the schedule for the rest of the evening. Our presenter will present with slides till about 8 o'clock. Hold your questions until 8 o'clock. At that point, we'll open it up to questions from the audience. I'll go around with a microphone, use the microphone. It's for recording purposes so that we can create an awesome learning resource that we can all use, for a long time. And if you need to use the restrooms or get some food, just feel free to do that throughout the event. It's a very casual event. So our speaker tonight is a thought leader. He's a leader in the financial space, and he's passionate about helping entrepreneurs succeed. So let's hear it for Kartik Gada.
Good evening, everyone. Thank you for making it over here, and it's great to be here and to talk about a subject that a lot of people are talking about, but it goes in ebbs and flows that are pretty sharp in both directions. blockchain in particular, but then ICOs and cryptocurrencies and what is in fact happening with those versus what is not, how it should be looked at, what direction the entire concept is going in terms of technology, markets, and so forth. Now, a little bit about my background in this is like I have a background in engineering, marketing, and so forth, but investment banking of all. And that involves traditional M&A and things like that. That's a small section of financial services. And as you see, financial services are the biggest sector in the entire economy. Bigger than government is 20% of the world economy. That is huge. And that is why fintech is a very large space, because on top of this being the biggest sector of the economy, it's also one of the most technologically outdated. One most resistant to change, for example. And that's why we're seeing a huge amount of innovation across every aspect of financial services. And a subset of that is blockchain, because we'll see how many different aspects of legacy fintech are going to be disrupted by blockchain and already are. But to truly understand where we're coming from, it's not just a turnkey thing, oh, these are the ICOs, this is what blockchain is. We have to go really, really far back. You have to go all the way back to the history of money. Now, what is money, right? And what is a ledger? We'll come to both of those. A means of transaction, a mean of recording transaction. But consider technology that has been involved in each. Now, one thing to look at, anyone who is very interested in technologies and exponential technologies is familiar with this type of concept. The exponential rate of return, accelerating rate of change. All technologies are exponential. As you can see from the chart, there's less progress than the linear trend for the majority of the time period. You could be 80% through the entire time period and it would look like nothing has happened. Then, towards the very end, the exponent catches up and you get a huge disruption. And that is why a lot of technological changes catch people by surprise, because they don't really understand this exponential concept. And even the ones that do, they don't know how to look for it in real time. They see things as being linear when nothing happens for years on end with exponential technologies. People forget about it. People outside the field completely lose track of it. And even people in the field are only looking at this in their particular field. They're not looking at it on the outside within a holistic sense of all technologies. But this accelerating rate of change is in all technologies, and that includes technologies that are not considered high tech, or more importantly, whenever we see anything that is seemingly low tech going towards high tech. And by that we mean moving towards a faster rate of continuous improvement. And the same has happened with money, or in other words, the means of recording transactions. So what is the history of money, very briefly? There was first a barter system. This went on since modern humans appeared, between 100,000 and 500,000 years ago, and maybe a little bit before that as well. And that, was very inexact, very imprecise. There's no means of true value assessment, so you couldn't create any markets. Finally, to create some standardization, you had physical tokens, either in the form of seashells or precious metals and things like that. That's around 1200 BC. And eventually you had bronze coins, silver coins, gold coins. And that standardized a unit of monetary transaction value within a particular empire, but there were two problems with that. Empires kept getting toppled and new ones coming in, and they would melt the old coins and make new ones and things like that. Plus, there was a lot of theft from the coins themselves. There was a very, very age-old practice of shaving the edges of gold coins until it got smaller and smaller and smaller. So if you got enough shavings off enough coins, you have enough to make another coin. And the coins would get shaved and really small. So that went on for a very, very long time. But 1200 BC, that's when you had actual physical tokens in use to any substantial scale around the world. Then paper money. Paper money has been around a lot longer than people think. It started in 618 AD, so exactly 1,400 years ago. But it's very controversial. It took a long time to get adopted. In China, they tried it first. It was considered very questionable. Entire empires fell over this concept because, hey, let's print more money. Oh, let's just print money and give it away for free, and didn't anticipate inflation. People actually died over the concept of paper money because either directly or indirectly, it caused a lot of turmoil and even the collapse of multiple empires, one after the other after the other. And didn't become mature until a time much more recent than you may think. A lot of people don't know this, but the United States didn't have paper money until 1862. If you watch a Western movie from that period or before that period, like, say, The Good, the Bad, and the Ugly, there's no paper money. It's only gold coins in that entire movie. There's no paper. They had banknotes and things. There was no paper money until 1862 in the United States. And a lot of people don't realize that. And now electronic money, ironically, started much earlier than people think as well. 1861, through the most primitive, rudimentary transmissions of transactions over, say, telegraphs and things like that. That was still controversial. Paying for things via credit card, it hasn't been around for that long. And paying for anything over the internet, digital transactions over the internet, that was controversial until very, very recently. Even when Amazon.com started in the 90s, people thought that was just, well, I can't just type in my credit card number over the internet. What'll happen then? What'll happen then? So that was not mature until quite recently, even though electronic money started in 1861. And now you have cryptocurrencies, 2009. Okay, that seems recent, only 9 years ago. But the takeaway here is not only do you have a more sophisticated technology that has more scale behind it, like before you're limited by how much gold you have, that's how many coins you can have. Printing paper money, the cost to produce is too little to be a problem, so that means we can produce a lot and create inflation, and that whole empire collapses, and all the notes have to be burned. But when these things have all started much earlier than anyone thinks, that shows the exponential nature of how these things go. Going back to this chart, for the majority of time, it seems like there's no progress. That's why you can see that, in fact, paper money's been around for 1,400 years, but it wasn't mature until much later. Electronic money's been around since 1861, almost 160 years. Didn't become mature until much later, and it's still not completely mature. And that's where cryptocurrencies are. There will be a lot of churn, a lot of new technologies incorporated into cryptocurrencies that people don't understand today. And ultimately, the cryptocurrencies that are most in use will probably not be the ones that people know about today, like Bitcoin and others. They also will be of a significantly different nature than the ones today. It's very hard to predict what that will be. But we'll come back to that in a minute when we talk about cryptocurrencies specifically. Right now, the history of money and therefore the history of fintech. So sticking with that. Now, what is fintech as an industry? It's a high growth industry, about 40% a year. And what you have here is that you have another exponential trend, disruption of many low-tech business processes through fintech, and it's growing very quickly. That's why from what is still just $12 or $14 billion a year as of 2017, maybe 30 billion in 2018, you're getting up to 350 billion plus by 2023, 2024. That's very large. That's why you have so many fintech unicorns and things like that, because of the high growth rate. Imagine when you're disrupting businesses that have 3 to 5% growth rate and disrupting them quickly under a 50% growth rate industry. Look at the speed of disruption that is occurring. But then what order of disruption occurs within fintech? And that's very important because there's even bifurcations within fintech. There's older fintech that peaked around 2015, and newer fintech as well. So to understand this, one has to look at the layers of disruption within fintech. The easiest with banking and payments. And this has been around for a while. Like PayPal was bought in 2003. So you have some degree of maturity over there because it's the easiest to understand, the most notable or simplest type of disruption that you can see and more easily adopted. Then you get to deeper things like cyber currency. And then finally, business finance, consumer finance, and others, and ultimately, eventually, distributed ledgers like blockchain, cryptocurrencies, and things like that. So you have to have some disruption and some maturity in the older types of fintech, mainly banking and payments, where even the tech companies are considered relatively mature in the space, such as PayPal and others, before you can lay the groundwork to go deeper and go into greater and greater disruption of fintech. Now, if you look at where we are, so the most recently completed calendar year, 2017, VC-backed fintech was rising a lot, and it was high. As you saw, 2015 was a particular peak because that was when the first wave of fintech had the highest valuation they had. Then it was a small retrenchment, even though that was mostly flat. The trajectory was not maintained because that generation of fintech had to mature. Now you're getting a newer generation of fintech. This is completed 2017 data and growth continuing into 2018. And remember, this is only VC funding for fintech. We're not even talking yet about ICOs and things like that, which we will soon see. But there's a lot of venture-backed funding in fintech, and unlike many other aspects of technology or sectors of technology, this is not disproportionately concentrated in the Bay Area, unlike certain things like artificial intelligence or semiconductors or things like that. This is actually much more evenly distributed with a lot of these startups in major financial centers of the world, which the Bay Area is not. But there's a lot of fintech startups in, say, Singapore, in Hong Kong, in London, New York City, and places like that. Certainly in Shanghai. And when you have this much venture funding going into fintech companies, you get a large number of fintech unicorns. And you can see many of them are in Asia, and about a third of them are in the United States. And several of these are not merely unicorns, but multi-billion-dollar unicorns. Stripe, for example, $9.2 billion in the US, Social Finance, Credit Karma. In China, the 3 of the 4 biggest fintech unicorns are there. And that shows how much disruption is actually occurring in that you have so many different fintech unicorns in so many different verticals. Now, I think most of you might be familiar with what each of these companies do, but you have payments, insurance, banking, lending, and a whole host of other financial verticals represented in these disruptions. Now, what are these verticals? Market map by sector, by Venture Scanner. And these are just the biggest companies in each of these verticals. Lending is very, very common. Everyone's familiar with Lending Club and so forth. Newer companies like Prosper and such exist. But there's a lot of opportunity there because in traditional banks, the fees that they charge are a large portion of the interest billed to the borrower. For example, why in the United States, why is the 30-year mortgage rate so much higher than the 30-year Treasury bond rate? Well, that's just the overhead of the bank. You're paying an extra 1.5% on that. The 30-year Treasury rate might be 3%, and the 30-year mortgage is 4.5%. So that's 1/3 of the interest you're paying. All of that can be optimized. It shouldn't be 1.5%. It should be 0.1% or so. And so there's a lot of opportunity for disruption in lending just from cost lowering. Personal finance. So a lot of these things are very complicated to manage. Many people are bad at doing that, as we know. And these apps help a lot of people in their personal finance. You can see quite a few companies in that. Credit Karma and others are well known. Payments, the first foray of fintech. There's just so many payment companies, not even ones like PayPal. But we would think, okay, PayPal, you can do payments over the internet, so we're done, right? No, there's so much more that can be done. There's Square, there's Stripe. There's so many aspects to payments because there are billions upon billions of payments every day. And the cost of the old network was immense. Visa and MasterCard charge 3% as a transaction fee, and that's been going on for 40 years. Now, 3% is huge when you consider all credit and debit card transactions per year are about $20 trillion. 3% of that is $600 billion. That's just the fees charged by Visa and MasterCard. $600 billion a year. I mean, the entire semiconductor industry is only $400 billion, where the fees charged by Visa and MasterCard are $600 billion. And why is it so much? Why is it 3%? It should be 0.3% or less. So there's still a lot of work to be done in payments, even though there's so many relatively mature payments companies. You have equity financing. Venture capital is done in a very inefficient way, and there's other mechanisms around that people are trying to break into this. International transfer. This is a huge market. People may not realize it, but worldwide remittances are about $450 billion a year, and the fee on that is 7%. So 7% of $450 billion is $30 billion, just fees on remittances, international remittances. $30 billion that could be made very, very little, because if it's secure on the blockchain, if it's not corruptible, if it can ensure that the intended recipient is the one receiving it, you save a huge amount of security that goes into that. And there's been no disruption in these things. Like if you look at wire transfers, for example, even in the United States, a domestic wire transfer is $30. Why is it $30? The same as it was 30 years ago. Why didn't it drop at the same rate that telephone call prices dropped, right? And international wire is $70 to $120, you know. And it hasn't been going down technologically, even though it should. And that's why this disruption, when it happens, will suddenly reduce that cost a lot. Whatever security and encryption is needed for a wire transfer, why does it have to be 30 domestic or 70 plus if international, or 120 even? It should be $1. Just looking at the technological capabilities that exist now relative to what the incumbent process is. And so there's a huge amount of savings in international transfer. Institutional investing, there's just so much that can be done there because there's huge pools of money. They want to do a number of things such as algorithmic trading and AI-based financial analysis. Kensho was one of the big companies you see here. It was recently acquired by S&P Global for $550 million. And there's a lot of opportunity over there. And then you can see even on the other side, like retail investing over here, everyone's familiar with things like Wealthfront and so forth, but there's just a lot that can be done. Robinhood, for example, commissions are free, which is a big deal because if you're doing a lot of day trading, then there's quite a bit in the way of commissions. Similarly, if you do any options trading, you know that options commissions are much higher than stock commissions. It hasn't gone down technologically, and they make a fat margin on that. So something like Robinhood can do a lot over there. Security, kind of self-explanatory, just the security behind fintech, because the hackers are getting smarter and smarter. There's an immense need for greater security, and a huge number of startups over there. The infrastructure of fintech and so forth, many companies dedicated specifically to that. Crowdfunding you see over there in the bottom. There's a lot more happening there. We know about Kickstarter and Indiegogo and places like that, but ICOs are also just an extension of the crowdfunding concept in some ways. And that's another thing that we see over here. Fintech keeps on improving something. It's not that when Kickstarter came out, it's done. That just means that the dam was broken, something that had very slow improvement, or in other words, with low tech, became high tech. Once something becomes high tech, it never plateaus. It just keeps on improving. So you turn something that had no trajectory into a high trajectory technology. And so on and so forth. Now, another way to visualize what all these verticals are, I mean, rather than look at, say, 1,000 different startups, is think of it this way, unbundling of a bank. Now, if you're a customer of Wells Fargo, as depicted here, or a similar large bank, of which there are only 4 or 5, you know what their interface is, you have to find something, everything is within one web page. And that's very, very inefficient, because this bundling has exempted them from the pressure of having to improve technologically. And you can just see so many startups are attacking each little aspect of what a bank does and lowering the cost of it. And if you're an extremely large entity that is officially protected by the government, which means you can be in a lot of suboptimal business practice for a long time before facing any actual consequences, then you are extremely vulnerable to disruption over time. Disruption may be delayed, but you will very quickly find startups that are 10 times better at doing one particular thing. And fine, one little thing is not a business in and of itself. But when you're attacking a bank from hundreds of little pinpricks, which all these startups are doing, then you get what we call, a comprehensive disruption, and that exponential trend that we saw is what you see manifesting over here. So you won't have a one-stop solution that charges a lot of fees for all of your banking services. before too long. You may have a unified interface that unifies all these smaller companies as one, but it won't charge anything close to the fees that a Wells Fargo or someone charges. Now, we saw a market map of all these different finance verticals. We can do a deep dive even one level deeper into the biggest fintech vertical, payments. Now, as we saw, payments is just one of the squares over here, right? The upper center square. Going deeper into that, you have another layer. This is all within payments itself, because there's so much to payments. Point of sale payments, Bitcoin payments, and every other type of payment. You can see even here there's hundreds and hundreds of companies, some of which are big, like Klarna you see there in the middle. That was a $2.5 billion company. Visa invested in that. Money transfer we talked about. So even within payments, there's 200 to 300 companies that are venture-backed, not even counting little startups, still trying to improve payments. People thought that when PayPal was acquired in 2003, and Elon Musk was one of the founders of that. Oh, okay, payments are now digitized. But no, if you went back to 2003 and saw how payments were then, you would find that to be very primitive, very slow-moving, inefficient, expensive, because once the dam broke technologically, then you can never get off of this exponential curve. Some would call it a Moore's Law type curve, but that's kind of a limited definition. It's much more than that. You will have continuous improvement, and the improvement ultimately never saturates. It just becomes the status quo that everyone is used to. Now, from here, we go to what a lot of you may be interested in, which is blockchain, as another example of fintech disruption. Now, one important thing to keep in mind, a purist would not say the word blockchain. The correct term is distributed ledger. Blockchain is merely the distributed ledger of Bitcoin. So to say blockchain is like calling a photocopy a Xerox copy, which is common in many countries. But since we're talking about blockchain and distributed ledger, we can see how that's really one of the most important disruptions in all of fintech, and extends even beyond fintech to many other industries. Everything from the legal system to oil and gas to government and so forth. So we'll talk about that. Now, a lot of you probably know a fair amount about blockchain already, so this will be relatively preliminary. But we'll go through it because there's always something new that we see when we examine this again. When a financial system was centralized, you have a clearinghouse in the middle. We see that on the left-hand side. And everything has to go through that. We were used to that, and everything seemed like it was orderly and centralized. There's a huge cost to this type of centralization. Instead, in a distributed ledger, no one node is that important. Everything is contingent on everything else, and everyone can see what every user is doing. Transactions are authenticated on the ledger so that you have something that's much harder to corrupt, much lower cost because it's not dependent on a central authority, and it can scale at exactly the speed that it needs to scale. And then what we do here is see, well, where can this take place? I mean, obviously, let's disrupt the thing that we're never done disrupting, which is payments. But no, it goes much further than that. How a blockchain actually works, or how a distributed ledger actually works. Someone wants to send money to someone else. Transaction is reported as a block, they call it. The block is broadcast to every party in the network. But under Metcalfe's law, the value of the network keeps rising as more people join it. As the number of nodes doubles, number of people on this ledger doubles, the value of the network becomes 4 times. Then those on the network approve of the transaction. They approve that it's valid. And it can be anyone at any time. The person who approved your transaction yesterday is not the same person who approved the transaction today. And that authenticates how each transaction goes. Then the block is added to the chain, so it's completely recorded, non-falsifiable. And because it's that way, not only is it harder to commit fraud, but a lot of people who intended to commit fraud will not do so because it's harder to get away with. So that's the hidden cost savings to the entire system from doing that. And then the money goes from A to B. Now, it doesn't take as much time as it may appear over here. It's not like you have to wait for someone to approve. Just whoever is on the network at that time who can authenticate it approves the transaction, it happens more quickly. And this is very useful, not only in terms of cost lowering, but even just in strengthening the integrity of the system in places where banking is not as robust or not as trustworthy. People used to do runs on banks and things like that. That need not happen when you have this. So just within blockchain itself, this is a blockchain-only market map, which is a subset of the fintech market map. You see all these applications in use for blockchain. Exchanges for coins and other things. There's 230 companies in that. Mining we'll talk about. What is mining? Why do you mine a coin? I thought we stopped mining gold for coins in 1200 BC, right? But no, there's mining. There's wallets that you store your cryptocurrency in, financial services and so forth. And then a whole bunch of other things such as blockchain core innovation itself, infrastructure, and the data associated with it. And of course, on the left-hand side, payments, because now payments itself moves to the blockchain. There's a lot of work to be done over there, and companies like BitPay and such are relatively well known. Now, when you have an exchange, like starting at the upper left-hand corner, what happens then? Exchange for coins, authentication. Some exchanges are very expensive because many cryptocurrencies are technologically primitive and take too much time or too much energy to process a transaction. So there's still a lot of innovation that needs to happen over there. Mining. Some cryptocurrencies, notably Bitcoin, are structured such that you earn more coins by solving difficult problems, and that process was mining, but that's become so hyper-specialized that the equipment to do mining has no other function other than that. So it's not done on your computer or even from an NVIDIA GPU. You have to buy something from Bitmain or other companies like that. And that's very energy intensive, which we'll come to. But these are just the verticals that blockchain has created, some of which comprise disruption of very old incumbent industries, some of which are completely new, such as mining. Mining is a huge consumer of semiconductor chipsets and has been credited with kind of reviving many old fabs and many aspects of the semiconductor industry outright. Many types of chips that they thought were, and process technologies that they thought were completely obsolete have been brought back to life just in a rush to create mining equipment. Same goes for things like exchanges and even just infrastructure. Okay, so the funny thing about blockchain is it disrupts aspects of finance, but it creates, in the process of doing that, its own type of financing mechanism. Now, this happened very quickly, so nobody's quite sure where this will settle. There are 135 blockchain startups with ICOs, and this is not the comprehensive list. This is just the ones that were big enough or early enough. Not all ICOs are blockchain. ICO stands for initial coin offering. And the hot period for that was from July of 2017 until January of 2017. So the hot period has ended. There have been ICOs after that, but not the ridiculous numbers from just a white paper that you've heard. But if you look at the blockchain startups with ICOs, you see a lot of the same verticals being disrupted and some of the new ones, from asset management to wallets, browsers, crowdfunding, prediction markets, and many, many others, in addition to infrastructure development and computational storage. So if you're a blockchain startup, you can raise traditional venture funding, or you can do initial coin offering, in which case you have a token. It's kind of like being a public company in some ways, but not others. There are pros associated with that. You potentially skip certain middlemen. There are cons also. The regulatory environment for that is still unclear, was certainly unclear at the time. And you also have an issue of ongoing costs as well as volatility introduced into your business from just having something converted to a tradable token while you are still technically a startup. So in the last part of this presentation, we'll go into more details about ICOs. But this is where you have blockchain companies do ICOs. Before I go there to that last section I mentioned, though, there's one very, very important piece that cannot be omitted from any presentation like this, which is the role of artificial intelligence in fintech. Now, you see what happens here is that artificial intelligence, in some ways, it's the end game of all technologies because it supersedes everything that a human might do at some point. Fintech is a disruption of traditional finance. Now, traditional finance has employed a lot of people, too. And sure, you have bank tellers going away because bank branches are going away because of payment networks and so forth. But that's just the beginning, because artificial intelligence, more than anything else, depends on data. The quality and quantity of the data it receives creates a more rapidly improving artificial intelligence. Now, any financial services company, especially a fintech company, generates an immense amount of high-quality data. Therefore, by necessity, it has to attract artificial intelligence. When it attracts artificial intelligence, you get a mechanism where there's an immense training ground for the improvement of AI that then diffuses through the entirety of the fintech company in question. So just AI in fintech market map, right? From CB Insights. Credit scoring and direct lending. There's a tremendous amount of data in credit scores and things like that. And a lot of credit scores are unfair, sometimes too high, but quite often too low. A lot more intelligence can occur there, and expansion of credit scores to other things to kind of simplify many other aspects of evaluation and due diligence. Assistance in personal finance. If that's an AI-based thing, then it's 24/7, everyone can access it, and you're doing very, very well in terms of your own personal finance sophistication and consumption, because you have this unlimited resource from which you can not only learn, but there's management of your own finances that you can do. Quantitative asset management. More and more transactions and trades are not done by humans in the capital markets, done by artificial intelligence. People have long worried this could cause a very big problem at some point. Someday that might happen, but it hasn't happened yet, at least in totality. So we'll see how that goes. The last time there was a major market crash and major recession, then we didn't have artificial intelligence in the markets. So we'll see what happens there. Insurance, very obvious use cases here, because there's so much data affiliated with insurance, but it's so inefficient. A lot of it is just processing and cost. People's auto insurance premiums should be about half of what they are just through diffusion of basic artificial intelligence into the insurance industry. And if your insurance premiums, say auto insurance, were half, a lot more people would get better coverage on auto insurance. Everyone would have collision rather than say, I'll cut corners and get rid of collision or something. When people do that, it's just because the product is too expensive relative to the demand elasticity, and artificial intelligence can solve that. Therefore, there's more insurance. Therefore, there's less problems associated with uninsured drivers and things like that, driving costs down further. Market research, sentiment analysis. This is obvious. It can judge sentiment very, very quickly and more efficiently than any other person. Going to the bottom here, business finance and expense reporting. There's a huge amount of data in just corporate expense reports about what they're spending on, what the return on expenditures are, and things like that. Just mining that data can provide a tremendous amount of insights to HR as well as to business, just about business practices in general, to the finance department and so forth. And then on the left-hand side here, you see the big one, regulatory compliance and fraud detection. The regulatory state is immense inside. They say the cost of regulations is about $2 trillion a year in the United States. And they're trying to reduce it, but which regulation when? You have to keep adding new regulations for new situations too, so there isn't a net reduction. But there is a huge opportunity here because A, the speed of doing business improves, regulatory complexity diminishes into something that doesn't require a huge expense on the side of both the government as well as the business trying to do something. And there's the whole area of this called the RegTech, as they call it, regulatory technology. Now, whether it deserves its own acronym or not, we'll see. But you do see a huge application for artificial intelligence over here, because look at how many things are so much more expensive than they should be in the regulatory space, or just in basic government services. Like, for example, if you want to do an LLC or C Corp in California, it's $800 a year plus the registered agent fee. Even if you do a Delaware LLC, you still have to pay the California $800. $800, what do you get for that? You just get the tax ID number that makes you pay more tax, and some support, which should be AI because it's 24/7. So the tax ID number should be on blockchain. The support should be AI. Every service provided would be more robust than what exists right now, and it shouldn't be $800 a year. It should be $2 a year, because that's what's technologically possible. If you look at products in the tech industry, Gmail is free, YouTube is free, Yahoo Finance is free, Netflix is $8 a month. You can never saturate that demand. Yet the LLC is $800 a year. And there's a huge opportunity for a smaller country to say, okay, we're going to provide the Estonia LLC or Singapore LLC or something that is on the blockchain. All support is AI. Everything is efficient. We're going to be $2 a year. Don't spend $300 at Delaware or something like that, or $800 in California. And then this becomes a huge disruption of an aspect of government services. And this is just one of many. Look at all the expenditures of government, all the services. Everything costs 10 to 100 times what it should, based on just what is possible through artificial intelligence and other aspects of fintech like blockchain. Now, if you believe that AI automates certain types of jobs, then you must also believe AI automates certain government jobs, especially ones that are very automated and repetitive, like ones in the regulatory space. Then you must believe that the cost of many government services and products, like LLCs, C Corps, or even like DMV stickers or something, could be 1/10 or 1/100th of what they are now, just based on analogous examples in the tech industry. And then you must believe those savings could be either passed on to the taxpayer or deployed somewhere else, and therefore, like, basic government services could be a lot cheaper. And that is the promise of this 1-2 punch, which is AI in fintech. AI for all the human touch aspects that exist in the regulatory and compliance state, and blockchain for registration of transactions and security, and what you're supposedly paying $800 a year for a California LLC and tax ID number for. And that is the big disruption of our age, because most venture-backed startups, they're trying to disrupt a $2 or $3 billion market. What about the cluster of startups? It can't be just one, obviously, but a cluster of startups trying to disrupt what is a $25 trillion market. $25 trillion a year, that's how much income tax is collected worldwide, so that's the size of government. Actually, the size of government's a little bit more, because they spend $5 trillion more than tax collected, $30 trillion market. And that has only just begun through these regulatory startups and other usages of blockchain and AI. Now, in the 10 minutes we have left, go to the section about cryptocurrencies and ICOs. Now, very controversial. Here's the thing. About a year ago, an event like this one about cryptocurrencies, with exactly the same presentation, they have like 200 people. Because, I know someone who just did a white paper and got $200 million. And yeah, that happened in a few cases, but that becomes kind of a distorted field. Everyone knows the same person. Statistically, that was a relatively small number. But now it's gone to the other extreme. We can't do that. That's not going to work. But let's look at the actual numbers associated with it. Total amount raised by ICOs. It doesn't go further than May. But yeah, there was a bust from the peak. The real peak was March. There's a regression of about 2/3. But it's still a level that was not reached until December of 2017. And you'll see the same thing with the price of Bitcoin and other cryptocurrencies. So ICOs were something nobody even knew about until the end of 2016. Even here, until March 2017, the numbers were very, very low. Then it started to take off just because the Jobs Act got passed in July, and there was big preparation. A lot of money chased it. Obviously, you'll have a bust because you can't sustain this trajectory. The question is, how deep does the retrenchment go? This is a total market cap of all coins out there. So Bitcoin included, from Bitcoin on down to the second largest, Ethereum, and so forth. The chart is linear, not logarithmic. And you can see that for the first several years, there was nothing. It was almost zero on the scale. As we saw in the beginning, cryptocurrency started in 2009. Even until 2016, there was nothing. Fine, the price of Bitcoin rose from what will be a few cents up to maybe $1 or so. Then suddenly there was a big rise. Was it justified? Perhaps not. Look at the gradient. Remember, it was a few months ago, there was a time when it was going up a few percent every day. And then look at the drawdown. And it's making lower lows, but still at a level, and you can see the date. This is current as of like yesterday. It's still at a level that was not reached until late 2017, November 2017. Now, we've seen chart patterns like this before, like with the NASDAQ. Those of you who were around at that time remember there was a steep rise, and it fell 80% from the top. And cryptocurrency is just that in fast forward. The whole thing's happening about 4x the speed. The run up, 4 times as fast. Top to bottom back in the dot-com era took 30 months, from March 2000 to October 2002, 32 months, in fact. So here, okay, 8 months. Now, nobody knows where it's going to rise or even whether cryptocurrency is even going to be the thing. I contend that it's not the disruption. It's just what's needed to blast a hole in the old incumbent system. When a disruption is extremely outdated, there's more and more technological pressure that builds up to disrupt it. And find because banks are very intertwined with government, they're too big to fail, they can push that off forever until the pressure becomes so high that something has to break through some part of it. Cryptocurrencies were a mechanism for that. They may not be the final mechanism, but someone somewhere had to blast a hole through the dam. It's a messy hole, a very jagged one, but they blast a hole through the dam. Then what happens? Okay, there'll be more mature products. Some of them could be of a crypto nature. Some may not be. But a lot of companies have found that everything from the fiat money system to the venture fundraising process was ripe for disruption. They fused all of that into ICOs. And because there's so many incumbent entities disrupted simultaneously, it's very hard to understand. Now, when you see companies doing ICOs, which now there's not as many as there were up till March or so, this is the general timeline that you have to do. Now, certain things are obvious, like with any startup. You do a team, you do a white paper. Now, traditionally, people would do a deck for a startup. The reason ICOs require white paper, only because the first cryptocurrency, Bitcoin, started from Satoshi's white paper. So everyone thinks they have a white paper. That'll go away. Eventually, it'll return back to decks. But then, but certain obvious things like roadmap, landing page, and all that are there. But there's now a technological component in this process as well, the smart contract, the initial code. Because now you have a cryptocurrency, which is itself a digitally designed entity, a token, and the smart contract that registers all of the transaction, who owns what, and everything. So now there's a technological component to that that has become irreversibly intertwined in this fundraising mechanism. Wherever this fundraising mechanism ends up, you have a low-tech system that has now become high-tech. And in the beginning, when everyone was doing ICOs, smart contracts were extremely expensive. During the peak of ICOs, smart contract developers said $80,000 to do a smart contract. Within a couple months, that became $20,000. A couple months later, it was $5,000, and now it's almost free. Just because a lot of supply crowded in, the market became less hot. Now everyone can do smart contracts, and they'll do it for a very, very low cost. A lot of people in India have learned how to do smart contracts. They do it for a surprisingly low price that will probably not rise anymore. So you have a technological component, and therefore you speed up. When you do a venture fundraising campaign to go from seed to Series A plus B plus C plus D, you might raise $100 million. That takes 7 years, and half of the CEO and CFO's time over 7 years is spent in fundraising. Here's an opportunity to front load everything and get it up front. Now, too many companies did that, many of them not with the best intention. They absconded with the money, so ICOs are in a bust right now. But the speed of connecting entrepreneurs and innovative ideas with money will never slow down again. There will be a maturation of this sort of thing rather than a return to the venture capital status quo where you have to visit Sandal Road 40 times, And both the investor and the startup have to be within a 10-mile radius of Stanford University. That's another problem. That's not what technology is about. It's about decentralization, not hyper-centralization. But the smart contract has inserted a technological component into that. The cryptocurrency is secondary. There are 1,800 ICOs. I contend there's not a need for more than 10 cryptocurrencies. I don't think there's a need for more than 30 fiat currencies either. But but when that consolidation occurs, you will get a normalization. Another thing that will have to happen in the cryptocurrency space is there's one problem that's going to be very painful for Bitcoin enthusiasts. Bitcoin is famous only because it was first. People have a tendency to think the first of anything is the best. I'm pretty sure that, that we've done many, many examples of that. Just because this is the first, it was the best. Same is true for Bitcoin. But the problem is, technologically, Bitcoin is the most inferior cryptocurrency to all. It is the most energy intensive in terms of transactions. Each Bitcoin transaction takes about 500,000 times as much energy as the Visa network, number one. Number two, this mining thing had a fatal flaw, which is that it's very vulnerable to ASICs, application-specific ICs. In the early days of Bitcoin mining, you could do it on your CPU. and people made some money. Then, the problems got harder. Let's get NVIDIA GPUs. We can do it on our PlayStation 4 or something. But when that got saturated, then you have these chipsets that are designed only for Bitcoin mining. They do it 100 million times more efficiently than your CPU. And that's the only way you can mine in a cost-effective way. But these computers are very expensive, like from Antminer. At times, they're as much as $3,000 or so. And there's always a big supply shortage or a supply surplus because they can't match it with demand, which fluctuates the Bitcoin price. So you have that problem along with two even worse problems. One, that hardware cannot be used for anything else. When your Antminer is obsolete after 12 months of using it, you can't use it for anything else. So it's a sunk cost, number one. Number two, mining is very energy intensive. Bitcoin mining today, these numbers are staggering. It consumes 1/300th of the entire world's electricity. 1/300th. 72 terawatt hours is how much electricity is consumed by Bitcoin mining. That's as much as an entire country the size of, say, Colombia. That's how much Bitcoin mining consumes. And since 71% of all mining is done in China, they just burn coal, so this is an immense emission of CO2. So anyone who cares about CO2 emissions, they should be 100% focused on this problem, because more than 100% of the net increase in CO2 emissions in the world in the last 3 years is just from Bitcoin mining. As in, if not for Bitcoin mining, there would be less CO2 emissions than 3 years ago. So anyone who cares about that issue should be worried about that. So that's the problem with Bitcoin. Now, to think Bitcoin is the store of value or anything that people will say, that's like saying, okay, the iPhone 1 will always be better than the iPhone 8 or any subsequent iPhone. Technology, doesn't work that way. It just gets more and more efficient. Bitcoin was limited not only in how it's mined, but it didn't have a ledger that you could create smart contracts on. Ethereum, slightly later, came along, and all these ICOs did it on the Ethereum ledger, the ERC20 contract, because you could create smart contracts. But even that's not good anymore, because now there's newer and newer coins that have newer and newer ledgers that are more flexible. So there's a continuously improving availability of ledgers, but then old coins on the old ledger, they either have to have a future-proofing mechanism, or they're stuck with what was state-of-the-art at a certain time, the Ethereum, or analogous to iPhone 2, or they're in trouble. So this is going to be a reorientation when they realize cryptocurrency is a technology, and the first one is not the best one. The first one is actually the most outdated one. That will be a big reorientation, and therefore the most famous cryptocurrency 10 years from now will probably be one that we haven't heard about yet today. So in closing, since we're almost out of time, coming back to the slide we saw before, when you think about ICOs, and you observe how many ICOs went bust, ones that raised a huge amount of money, many are down 90 to 95%, and maybe they shouldn't be, that's the fair value. But just think of all the opportunities of what blockchain is disrupting. Now, companies that have nothing to do with blockchain have also done ICOs, but ultimately it makes more sense if you do it for an entity that is making a contribution to the blockchain. And that's how you can think about all of these different threads together. Blockchain, ICOs as a funding mechanism, artificial intelligence, a huge piece of this because it generates so much data, therefore all ICOs and all blockchain-based projects have an AI component, or should very soon. And the context within broader fintech, which seems like an old, mature industry because it's a few years old, but it's not a few years old. There's still much, much, much more to come, even in terms of the mature or relatively mature vertical, payment, banking, and so forth. And you will see a lot of big companies, even in those spaces that we have not yet heard of yet today. So with that, we conclude the primary presentation, but we can take some questions.
First of all, let's give it up for Kartik. So we'd like to take as many questions as possible. This is a very intimate setting. It's almost like a graduate seminar. By the way, Kartik is teaching a class at Stanford this quarter.
It starts on September 27th, so in a few weeks' time. It's available to all. It's in Continuing Studies Business 237, where I cover all these technologies, fintech being one, but artificial intelligence, energy, autonomous vehicles, 3D printing, and others, one each week.
Right. So you can actually take advantage of his expertise without taking the class, without spending that kind of money by being interactive today. So who's got a question for Kartik?
Yes.
One at a time. Hang on to the mic. So hang on to the mic until you're done. Feel free to have as many comebacks as possible.
Yeah. Can I ask like two questions at the same time?
Yeah.
Hey, thank you for the presentation. Firstly, gave an overview of the entire landscape that we can see today, like with AI and blockchain. So my question is regarding the last points you mentioned regarding Bitcoin, right? So the first point I think you mentioned was that it consumes like too much electricity, right? So I read somewhere, I'm not sure, that it consumes like 0.3% electricity of the entire world.
Yeah, 1/300th of the entire world. That's right.
That's 0.3%, right?
Yes, which is a lot, as much as a country the size of Colombia.
Yeah, it's definitely a lot. But do you think that it's justified based on the security that is providing?
No, because technologically it is not as good as newer coins. It's just more famous because it was first. The newer coins are much more efficient energy-wise. Plus, that activity is not throwing off any other technological innovation that's useful elsewhere, other than maybe power management in chip design. Because if you look at those ant miners, they have a huge fan and they're very loud and they're heavy, and it's very brute force heat sink type of design. If we were talking about hardware design, it's a misdirection that is hyper distorted because of the desire to make money from Bitcoin mining, and it will collapse very quickly because it's drawing away resources from every other technological innovation. There was a shortage of ant miners. That's why there weren't enough chips for AI and servers and things going on. NVIDIA's GPU, it's 4 years old, yet it cost more than 4 years ago, which is unheard of in any semiconductor industry. I thought, we had Moore's Law and things like that, just because Bitcoin mining is using up all the GPUs and they can't produce enough, so they don't have to lower price. They have 90% margin, and NVIDIA's stock price reflects that. Very distorted, it'll collapse extremely quickly because this type of resource misallocation within technology never lasts very long.
Yeah, and second, the mining effect having problem on environment, right? Why do you think that's a huge problem?
Well,
because there are other things that are affecting the environment, right?
There's other things, but we're talking about this now. I'm not saying someone should or should not care about CO2 in the atmosphere, but for those who make a lot of noise about it and say, oh, America did this, America did that, whatever CO2 increase has occurred is not only not in America, but it's due to one very specific thing. It's not reducing anyone's poverty. It's not doing anything. It's just Bitcoin mining so that the miners, which are all industrial scale things, you can't make money as an individual Bitcoin miner anymore.
Yeah, and the last question, but so you mentioned that the first one would not be the winner, right? Because even if like Bitcoin narrates its story regarding store of value, right? There's other technologies that are coming which are improvement, right? But don't you think to be a store of value, apart from technology, the first thing that you need is liquidity? And Bitcoin has enough liquidity. Gold is a store of value because it has enough liquidity. It's not because you can use gold for something else, firstly, right? So do you think that like even if there's something better technology than Bitcoin, it would not have that amount of network effect that Bitcoin has already achieved? And since it's not that liquid, I'd rather not put my money in it.
Well, Bitcoin's liquidity is high only compared to very few other coins. First of all, transaction cost of Bitcoin is much higher than Ethereum and so forth.
But for store of value, it doesn't matter.
But it's only a better store of value compared to other crypto. It's not a better store of value than like the US dollar or anything like that, right?
Of course, but like when it comes to technology, it's still against, you compare it to the other crypto, right?
How is it a store of value at all compared to US dollar, gold, real estate, S&P 500? That's the way to look at it.
It's just 7 years. I mean, I'm not saying that like
store of value that fluctuates 10% every day.
Gold is also volatile.
Well, gold's not a great store of value either. In fact, technology ensures gold price will drop over time. It has dropped 40% despite 20 trillion of quantitative easing. And I've written a whole book about that subject. But store of value doesn't really make sense because, A, its market cap's only $145 billion of Bitcoin, which is too little to be a store of value. It is not liquid enough, and it is not stable enough relative to other things that are out there. In fact, they have that whole HODL movement to hold Bitcoin to keep the price floor high, when people have to be encouraged to do that rather than trade it freely so that it remains viable, because if it goes below a certain price, it could be a death spiral. That doesn't sound like store of value either. Like, you could always buy land, right? That's a store of value.
Don't you think it's just a baby right now? Gold has been there for long years. And
crypto, yes. Bitcoin, no. Bitcoin is to crypto what iPhone 1 was to all other smartphones of 2018. Think of it that way. Yeah. And who was next?
Carlos here. Thank you for coming. I enjoyed your presentation very much. 2 quick questions. First of all, I saw you had a slide there talking about unicorns. I'm just curious, how do you define unicorns? Because I've heard it a little bit differently elsewhere.
Anything with $1 billion market cap is a unicorn. If it's still a private company. A private company with $1 billion valuation is unicorn. At the moment, worldwide, there are 200 unicorns comprising about $1 trillion of value each. The biggest is Uber, but the biggest fintech one was Lufax that we saw, a Chinese insurance company.
So these businesses actually exist, not like a unicorn that's mythical.
No, these are actual businesses, and many of which are well known. We saw Stripe and Credit Karma and ones like that as well.
Right, that's where I was a little bit confused as to what you were
SoFi,
describing.
Social Finance, Oscar Health. These are actual businesses you can transact with, right? Klarna.
And then my
Like
second
Uber is a unicorn. Everyone uses Uber, right? So that it's the biggest unicorn, 68 billion.
And then the second question is for the cryptocurrencies, where are they getting their standardization from? Who's the go-to person to say this is how you're going to develop
It's
it?
very strange because in the blockchain community, it still operates to the extent that some very respected people within blockchain they have a huge amount of power in approving what is considered a legitimate contribution to the blockchain or not. And fine, it's very early, so that still happens, but there's still some very unofficial authorities that are relatively powerful in blockchain. Just like with Bitcoin, for example, a lot of major Bitcoin holders have a lot of power in terms of like moving Bitcoin itself or persuading people not to sell, like that HODL movement or things like that. So it's not mature in that regard at all.
Thank you.
Yeah.
Thanks again for your very enlightening presentation. A question that I have is regarding if you have to think of a single or two bottlenecks towards scalability, proliferation, and eventually replacement of the existing fintech system.
Existing finance system.
Correct.
Yeah.
Would you think that the bandwidth or mining would be a problem? And if so, would that trigger maybe next generation of computation, maybe quantum computing? And the other possible bottleneck, could it be that Bitcoin and any cryptocurrency eventually is finite? It's not like dollars it's a finite number of it.
Yeah.
So can you comment on this bottleneck and scalability?
The bigger bottleneck, so disruption of the financial services industry, which is different than cryptocurrency. I'll address that second. The reason financial service industry took so long to be disrupted because they're very intertwined with government. Some banks were made too big to fail. A lot of these mid-tier banks had to go away. That happened in 2008, 2009. And the problem with that is then the disruption gets delayed and moves higher in the chain because now you have to disrupt the government itself. When a very inefficient entity gets more and more intertwined with government, then the technology starts to work on not just the entities, but the government itself. And this is where certain things are going and where some cryptocurrencies have arisen from. Also remember that a lot of banks have software that's written in the late 1960s and early 1970s, which was written in COBOL, which people don't study anymore. So on one hand, okay, all the code's in COBOL and it's very old and it's not efficient, that's there. But then nobody writes viruses in COBOL anymore either because people who are hackers don't know COBOL, so it's safe in that regard. And so that allows the disruption to be delayed for a long time. And the other factor is many countries that have a less sophisticated banking system can leapfrog very easily. A country like India, which didn't have a sophisticated banking system, now has one that's actually in many ways better than the United States because they could get past many generations of technology and go into one shot. So the banking experience in India is actually better than in the United States, as hard as that may be to believe, because a few years ago, the opposite was true, but now it has successfully leapfrogged. Same with China. All these financial services and the way people pay for things and all that is just very, very sophisticated and seamless because they didn't have to undo an incumbency that way. Now, with mining, your second question, mining is a function of Bitcoin, and when the creators of Bitcoin invented something, they made this one flaw by making it very ASIC vulnerable. Therefore, now you have thousands and thousands and thousands of people buying these Antminer units. There's more than 1 million of those just to mine Bitcoin, generate all the CO2. That hardware has no other use. It's taking away resources from everything else. It's very inefficient. Ethereum is more ASIC resistant. So you cannot mine Ethereum with this like Antminer type computer, so it's not creating that hyper distortion. And newer cryptocurrencies are even more and more efficient there. Like if you want to make money from mining right now, there's a cryptocurrency called Zcash where the miners are relatively inexpensive, $20,000 each, and the yield is very high. You could break even in 83 or 84 days, right? But in general, mining, was never meant to be the main event itself. It was meant to just make things more sophisticated through more participation. When it becomes the main event, which has occurred with Bitcoin, then that's the cart before the horse. And that shows that despite something that was so elegantly designed, you create one little flaw, one pinprick, and that kind of makes the whole thing problematic to the next coin, which can just say, oh, we'll fix that flaw, now we have something better. So that's what's going on with mining as a function.
But as cryptocurrency scales, this seems to be the bottleneck.
It's a bottleneck with Bitcoin. The newer ones don't have this bottleneck. But at the same time, this bottleneck of number of coins. When you have so many coins, what do you do then? Because like I said, ultimately there's need for only 10 cryptocurrencies in the world, and it will consolidate to that at some point. We don't know when. It could take several years, maybe 15 years even. But ultimately, you don't need more than 10 cryptocurrencies, because how many feature combinations and permutations do you need? Just like when there were 6,000 mutual funds, right? Why do you need all of those ultimately? You only need a handful.
Can you comment on quantum computing and where it falls in this?
So here's the thing. There are a couple of companies that claim they have quantum computing. In fact, there was an interesting contest just about a year ago between IBM's quantum computer and University of Maryland's quantum computer. Both had 5-qubit chains. And as you may know, each qubit is kind of exponential in increasing the strength of the quantum computer. And they tried to see who won. But those are still very preliminary quantum computers. And how do we know there's no quantum computer? Because all the remaining Bitcoin, which is unmined, which is still 7 million Bitcoins or $50 billion, has not been claimed. Because once someone invents a quantum computer that can mine Bitcoin that quickly, every block that is released will only go to them. Now, Bitcoin does have a fail-safe mechanism, so you can't mine all in one day. There's like a certain amount of time, but no one else will ever get any. So some entity, which would probably be a corporation, but let's say a corporation like IBM or something, would get all the remaining Bitcoin. So the unmined Bitcoin is effectively an innovation prize for quantum computing, and since that has not happened, we do not have a quantum computer yet. The issue, though, is blockchain. It's secure because its main barrier is computational complexity. As computation gets more powerful, distributed ledgers have to adapt to be more powerful than that. The blockchains that seem secure in 2018 will be very preliminary and easy to break in 2030 when there probably is a functional quantum computer. Therefore, the ledgers at that time have to be so much more complicated than the ledgers that exist now. Functional quantum computer might still be 14, 15 years away from doing that, but all these security mechanisms have to be rethought completely, because things like seemingly strong passwords or distributed ledgers that house all transactions all are very, very inadequate relative to what computation will be then. Just like if you had an old 1999 Windows PC in your closet and you try and plug it in and surf the web today, almost no website will load up. Yeah, very analogous situation there.
Just to add in, I think the biggest bottleneck to scalability is storage. The storage is the biggest problem. So
But storage is scalable. We can make
storage improves at a rate faster than Moore's law, but
that fast as adoption is increasing. That's what I'm trying to say, right? It doesn't move as fast.
It scales, so we can make more hard drives and
yeah.
and holographic memory. But
Now, there are times where generation of content exceeds amount of storage in production, but those two always match up. Storage prices during that period kind of failed to drop, just like the NVIDIA GPU price has been flat for 4 years. So hard drives from Seagate and others would also be flat for a number of years as that catches up. But that distortion never lasts very, very long. And then you also have innovation in storage. Like we went from these rotating disk drives to flash drives and other things like quantum storage and cloud storage and things like that. So storage innovations catch up very, very quickly. But so I wouldn't say that's that much of a bottleneck. Plus Bitcoin, how much storage does it really use, or how much do the other cryptos really use it?
What I was trying to say is that you could do, say, Visa-level transactions on Bitcoin today. The reason you don't do it is because it's the storage bottleneck.
No, you don't do it because of cost. The transaction cost and energy consumed are both many, many times higher.
But energy consumed for, say, 1 million transactions per second per block, or 10 transactions per block would be the same, because it's just hashing. It's the amount of data that you're sending through the network and the amount of data that every single miner has to store as the data starts increasing, the number of miners starts reducing, and then you just have Google or NSA storing Bitcoin because they have that enough of storage. That's why you need to have that artificial cap on the block, right? Even if it takes 10 minutes of time of the efficiency, it doesn't matter how many transactions you do it.
But
Because it's just one hash. It's just
That's another structural bottleneck in Bitcoin, though. Because yes, there could be more transactions so that the cost per block goes down. But when it's too heavily storage biased, it becomes the opposite of what it was aiming for, which is decentralization, democratization. If only United States government or Chinese government or Google can control Bitcoin, then that's another fundamental flaw.
the problem happened that a lot of speculators got in because it was assumed that storage would keep increasing as adoption increases. So I just don't want to hijack the conversation.
Who's next? Yeah.
Thank you. So you focused on fintech. My question is, do you see blockchain being used outside of fintech, and if so, what areas?
So very important areas are government itself. Let's see. Okay. See, even here, so that's a very good point, because over here, these are all finance and somewhat finance-related aspects of blockchain technology. A market map like this should cover everything. There's tremendous usage in government itself, in the legal system, because the way legal system is done, it's very inefficient. Some lawyer somewhere is looking up some precedent of case law, and there's hundreds of lawyers looking up different precedents of case law. All this should be on the blockchain, so it's easily referable, speeding up velocity of cases and reducing the backlog. Oil and gas is another very, very important area because there's so much data on all the pipes and all the extraction sources and everything like that, that there is just a huge amount of efficiency to be had in recording every minutia of data of every aspect of the pipe, because there's still 20-30% of losses in all oil and gas in general. So those are some of the bigger applications of blockchain. And there are lists that list, these are the 20 industries being disrupted by blockchain. Most of those are not in fintech, but these are the 3 or 4 biggest ones. Legal system, government, oil and gas.
Thank you.
Who's next? Yeah. Yeah? All right. And one parting thought, I've actually written a book on online publication, which is free online. It's gotten 450,000 views. That's the URL for it. It's about automation of government, monetization of technological deflation, usage of blockchain, artificial intelligence, and so on to create not only a government system that costs a tiny fraction of what it costs now, but then repatriating all of that surplus elsewhere. And other things like government payments generate so much data that those can pay for themselves in many ways. Just like if Facebook, Google, and so on, their product is seemingly free because they're monetizing the data. Well, the social security checks and things that government sent out also generate enough data to pay for themselves, so it doesn't have to be funded through taxation, things like that. Automation of all of these processes. It's been featured in a Google talk as well, but 450,000 online views, freely available. You should check it out. So anyway, thanks for having me here, and it's a great session. Unless there's a few other questions. Yeah.
Well, actually, we have a raffle. Do you want to do the honors?
Absolutely.
Drum roll. And the winner is?
The thickest business card. So let's see. Saeed Ahmed.
Saeed.
Hey.
Oh my God. Oh my God.
You were controlling the door, so you put 5 business cards there.
All right. So we got lots of food. Feel free to take some home. Conveniently, they're in Ziploc bags. So feel free to talk to
There you go.
Kartik one-on-one.
Awesome.
And thanks for coming. Thanks for coming. We'll see you next time.